Uh, all right, okay. And we are going to talk about the topic of investing and growing a tech startup company from the legal side. So my name is Hana Monica. I'm the Senior Legal Manager at Ruang Guru. And so before we start the discussion going further, I'd like to set up some rules here. So I'm going to have some sort of question and answer with the panelists for about 40 minutes. And then if you then have question to clarify, or if you have something that you want to dwell into, you can just put in a question and answer, and we probably can answer that in the next 20 minutes or 15 minutes before the session end. And I will try to make this session as interactive as possible, and like covering question as many as possible, but noted that there might be possibility that your question might not be answered. Okay. Okay. Yeah, so without further ado, I want to introduce you with our panelists here. So we have 3 awesome panelists here. And also what will be very interesting in this topic is that sometimes like in outside discussion, we know that there are a lot of discussion going forward about startup, like how to create a sustainable business models, or how to thinking on the investing in a startup from the business side, but rarely discussion happen talking about the legal side of the startup. So I have 3 awesome panelists here, which I believe can give a holistic view on how to invest and growing a startup, specifically from the legal side. So first we have Nathaniel Manuel. He is now currently work as the managing partner at Atrem Law Firm. And beforehand, he worked as a general counsel at Gojek for about 4 years, and at Ruang Guru for about 1 year. And then beforehand, he also worked as the corporate lawyer for about 12 years. So hello, Nathaniel, how are you?
Good. Thank you for having me here.
Yeah. So he's actually my mentor when he were in Ruang Guru, yeah. So and the second one, we have Dennis Liu. He is now working as a VP of Legal at East Ventures. And beforehand, he works as the head of legal at GoPay for about 4 years. And before that, he also worked as a corporate lawyer for about 4 years. So how are you, Dennis?
Good to be here. I think Liu is the mentor for everyone. He's my mentor during my time with the workplace. So thank you for having me.
Yeah. All right. Okay. And also we have Florence Gracia Santoso. She is now a director of legal at Alpha JWC Ventures. And beforehand, she worked as a corporate lawyer for 8 years and worked in Alpha for about 2 years. How are you, Florence?
Hi, Hannah. I'm good. And
yeah,
thanks for having me here.
Yes. All right. Okay. So we know that like in startup, right, there we can classify as a 2 big parts, right? First is the seed side, or the seed investor, or usually when the investor want to come to the startup for the first time, right? And then there might be just like discovering the business model, etc. Right? And the second one is the session where the startup going into the later stage. So let's talking on that 2 sides, right? So let's talk first about the investing in a startup. So I want to ask my first question to the investor side, which is to Denise and to Florence, right? So if the investor wanna invest in a startup, right? So what are the legal things or legal matter that the investor need to be aware of? I think we can start from Denise first, and then can go forward to Florence. Yeah.
This probably remains true in the later stage of funding. The decision to invest will mainly be driven by business or people side, right? So the difference from legal perspective is whether there's any legal risk, and whether such risk, for example, like the most common one, the absence of license, will impact the decision to invest, right? And the type of mitigation that will be implemented towards such risk. I think that one might be different in different stages of fundraising. But for early stage, I can say that from legal perspective, usually there'll be very limited due diligence. I think the reason is, sorry, can you hear me well? Sorry, because I think one
I
of
think
the attendees.
the sound is very small.
Is it okay now?
Yes, so much better, I think.
Yeah, so I think, okay, let me repeat my answer. Thanks for the question, Hannah. In early stages of a tech startup, say seed, pre-A, probably Series A, and I think this probably remains true in the later stage. The decision to invest will mainly be business and people driven. The difference from legal perspective, I think, is whether any legal risk that is found, for example, like the most common one, right, the absence of license, will impact the decision to invest, and what are the type of mitigation that will be implemented towards such risk from the investor side. I think that one might be different in different stages of fundraising. But for early stages like seed, from legal perspective, usually there'll be a very limited due diligence. I think the reason is because, there are a lot of funders come to us with the ideas of business that haven't really operationalized yet, right? So they come and they still trying to find a form, and that's why there'll be a limited legal due diligence just to make sure that the entity is well established and whether they are aware that they might require, any business license to operationalize or to roll out their product. And any findings at that stage, I think, will be mitigated by, having a condition subsequent post-fund disbursement. But I think that will rarely impact the decision to invest at early stages. The condition subsequent is, the undertaking from the founders or commitment from the founders or the company to actually fulfill the condition post-fund disbursement within certain period of time. But from early stage investor perspective, that will rarely impact the decision to invest.
Okay. Okay. Florence, how about you?
So actually, our consideration is almost similar, and I think Denise has already explained it very clearly. But the thing that probably I want to add is with regard to the restructuring of the company. So I think for us, which most of our team are in Indonesia, so we are sometimes still comfortable to invest in Indonesian company, Indonesian PT, which is still owned by the founders. And sometimes for early stage, we invest through convertible loan or convertible notes. But the thing is, like with foreign investor, even though at early stage, sometimes they will request for the Indonesian company to be acquired by Singapore company as a holding company. So, but yeah, it sometimes it depends on the appetite risk of each investor, which is, yeah, it's a little bit different from the one in Indonesian investor and the one from foreign investor.
Okay, so I note that from Denise that I probably can assume that in the early stage, like the basic license will be sufficient for the investors, right? And then if they see there's something that need to be check about, they will use it in the CS, like condition subsequent after the disbursement, whatever, right? And then for Florence, I got a sense that usually the investors, like in the early stage, they actually tend to invest in an Indonesian company, like a PT company, but like even some investor, they also want to check whether they can also make a holding in the Singapore, right?
Yeah.
Okay.
That's right.
Okay. 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 Now that will be from the investor side, right? So now let's delve into the company side. I want to check to Nathaniel. In this case, if the investor want to invest in a startup, what would think that the company should be aware of before the investor coming into their company?
Yeah, thank you for the question, Hannah. And first of all, thank you for Judy and all the team from NYU to host this Sinway. NYU is a very good school. You can check website. We have business schools, we have law schools, and we have distinguished alumni. And one of the things why we kind of doing this is, in the recent years, like people like Denise and Florence have the benefit of learning about venture capital, have the benefit of learning about a lot of things that we're talking about now, even like in real time and working with the business students. So you should check it out if you're kind of interested to know and where we learn it. It's not just experience, but then also study kind of courses to support that in NYU. In regards of the topics, I think we have some attendees here that is maybe still thinking to start a business and see how the legal will be relevant to that. I think the basic premise is you just have to be sure of what you kind of want to do. As is similar is that I have a client, a founder that is just want to do 1001 items and say, what do you want to do? What is the most matter to you? And this is where it comes to a business idea. What is your business idea? Let's say one of the things that it's not my client, but I look at now, you get like coffee businesses that is bespoke, right? You get like, and then you have a good coffee near you, like Kopi Kenangan. I know one of you guys might be invested to that, or Fore, Fore Coffee. I know Evie is there, but really, what is your core business? What do you want to do? Are you offline or online? Meaning, are you like coffee is literally you selling coffee to people. If it's online, meaning you are marketplace, you may be connecting coffee stores or like, for example, like Gojek or Grab, connecting coffee stores and delivering that into like food delivery business to others. That will impact largely on what is your core business. So that's where it comes into what is your line of business? What do you do? Let's say, oh, I am doing a coffee sale. So it's a cafe license, and you kind of check, is it possible for us to open a cafe license? If you ask me like 10, 15 years ago, it's like close to foreign investment. But recently, I think more like after 2010, if not mistaken, or more, is already open. And then you can have foreign investment in coffee businesses. So then what it means when it's open or closed, we don't talk about the omnibus law. It's already, that's a different topic. But what matters is that you're able to give people to invest in your business. So that's also a business questions. I have an idea. I want to do it. I have some capital, I have savings. The line of business is legal, or there's maybe something that I can use like coffee business or marketplace for, connecting people throughout my platform. And next thing is that how do you want to run it? Do you have enough capital or do you want to raise funds? So that's where all the legal will come into, because when you raise fund, the investor will asking, what are your license? Have you got that license? Okay, if you get that license, are we by law able to invest as a foreign investors? Then, it's open, it's closed. If closed, how do you structure us to invest? So a lot of things will delve into the core business, but first of all, it has to be quite certain what's your business, and legal analysis have to run through whether it's open, whether what's kind of the license, whether you have the license or not. So that would be a kind of secondary question. And I also note the kind of recent trends whereby, as you need to prove the business model first. So in the beginning, rather than thinking about fundraising, you spend, like if you start a business, you spend your 6 months really try to prove it's a workable business model and can be scalable, rather than thinking the legalese. But by that time you say, oh, I can do this. And then you talk with some people and friends and family, they say, oh, I want to put money in you. And then you have like more bigger investor, I can put big tickets to you. That's where you start all this thinking process and, talk with a lawyer or lawyer friend or people who understand legal to give you advice on the structure of the company and how best to fund your company. In reality, it might not be the best, and my venture capital friend here might disagree. It might not be the best, basically, to have your early demands funded by venture capital. It has to be proven at some stage, because one of the things that once you get that money, meaning your ownership will be diluted. So you need to find a way where your valuation is as you feel as comfortable. You still controlling the company, and then you get enough funding and that funding can make you scalable. It's also business calculations, and in the end, you have a good run rate for the next funding. So that's all the legal stuff that we talk about is kind of ties into the business strategy and the business that you do, and you make sure it's workable and it's a good business. So that's kind of the first thinking, and I'm happy to answer more specific questions. But prove your business, make sure it's doable, make sure it's sustainable, and then make sure that at one point it can be scaled. And once we are ready for investors, we can structure it the best way we could with the investors.
I think what I get from your experience is that from the first time when we wanna make a startup, right? The legal side can be put as the secondary, right? And then let's see like how the business model, whether it will be sustainable or not. And I think that will be also in line with what Denise said, right? In terms of seed capital, you don't need to, I think like she said, like founders come and then just discuss and they need money, right? So yeah, I think for that case, probably enough for the founders to think about the strategy first before going deeper into the legal things, right? Okay. Also, I want to check from Florence perspective, right? Since you also work in the ventures, right? So, do you think there are some legal terms that need to be aware of by the business teams, right? If they wanted to invest in a company, like what will be like the legal terms and legal matters that need to be aware of from the business team that will be really related to the company itself?
Okay, so yeah, so the thing is, usually founders come to us is the one not from legal people. So mostly they do not really understand the legal terms, even the basic one. So I think the first thing that they probably need to know is like, so we usually what terms that we will require for the founders is usually to protect our interests, of course, as the investor. So we will require, like, first we usually put a director there. So basically, usually for every round there will be one director be put in the company, but it's usually the representative of the lead investor. And the second one is like mostly like we also, because the thing is when we invest in the startup, basically we invest to the founders because most of the company are still is not proven yet. So every time we invest in startup, I always explain to them like we believe in you, which is the founders. So and we want the founders to stay in the company and grow the company. So that's why like we usually there is a clause which we call lock-in provision, which we require the founders to remain in the company for a certain period of time, usually like 4 or 5 years. And actually, in order to do that, we also do the vesting for the shares of the founders. So usually it would have one year cliff. So if it's 4 years, so each year the founders will own the shares like 25%. So the thing is like, so legally they already own the shares, but it's still subject to repurchase in case they are like leaving the company before the lock-in period. And even for the leaving itself, there will be like good leaver and bad leaver. So bad leaver would be like, for example, like the founders do fraud and like jeopardize the company and the reputation and everything. So it's fair if we do not pay the real price for the price of the founder shares. But it's different from like good leaver if in the event like there is something that like the investor think that it's still reasonable. Like for example, if we do not visit, like for example, like the founders is getting sick or something and they cannot work anymore. So it's something that's like beyond the control of the founders. It can still be considered as good leaver. And I think each investor has their own terms as to how to calculate the founder shares when they leave the company. And the other things is like we have the what we call the liquidation preference. So in the event the company is liquidated, so the investors should get the money first before the founders, because the idea like we put more money to the company, and also yeah, as we said, like we believe in the founders, and if you happen to, if the founders can happen to cannot return what we are investing, so we expect that at least we cut the first cut of the cake before the founders get anything. And the other, like, I think it's pretty standard for other any joint venture, like we will require like reserve matters. So for certain matters needs to be approved by the investor. And also like for the shares itself, like there will be like the preemptive. So in the event they do the next fundraising, the existing investor should get the first right to subscribe. And there is also the right of first refusal. So if the founders want to sell the shares, they need to offer to the investor first. And which is quite different from the from the other joint venture arrangement with in other company other than startup. So for tag along, it's usually the investor can only can tag to the founders, but not the other way around. Because for tag along, so like tag along is like if someone selling the shares, the other shareholders can also sell their shares. The idea is like for investor, we especially for VC, we will not be investing like indefinitely. At certain point of time, we will need an exit. But for the founders, like because we build, so the founders should stay and grow the company. So when they need to leave, they also need to think about the investor, because as I said, investor invest because we believe in the founders. So when the founders leave the company, so it's not actually we will not run the company, because it's supposed to be the founders who run the company. So I think that's the most the usual and most terms that we usually discuss with the founders. Probably Dennis want to add something.
Yeah, sure. Florence, just to add some colors to it, I think we, for early seed stages, right, the investors have, I think, much more aligned interests with the founders and the company, because you invest in these founders and company because you want them to succeed, right? If they succeed, then the investors are also succeed. So I think much more the interests are aligned, but just to add some colors, for the founder side, I think you also need to pay attention to the valuation. You need to be on top of your mind, your cap table. You need to know how many percentage of ownership in your company that have been sold to the investors. You need to be aware of the type of security, whether it's a convertible loan or whether it's an equity. And you need to also think about ESOP, how many stock option that you want to set aside for your key hiring, because in early stages of funding, you might want to be able to offer those stuff to your key hiring. And I think the rest of the items have been shared by Florence. And also on the reserve matters, you want to make sure as well, you have a certain flexibility as well to run the operations of the company. Because, from investor side as well, we believe in you and we want you to decide, on certain aspect on business and operational in the company. So usually that's that sort of balance that we will seek, in discussing these terms with the investors. But on top of the terms, I think just to add some colors for the founders and for early stage company or startup as well, is that as probably Florence and Neil have already mentioned, there are some legal concerns that you might want to pay more attention to. I think the reason is because you want to avoid the time and cost of having to restructure it at a later stage. The first one, I think, is the entity for the investment. As you might be aware, some offshore-based VCs, incubators like YC have certain limitation of jurisdiction that they want to invest in. Usually in Indonesia market, we see that the company is being established in Indonesia, but you might need to restructure when you try to seek funding from these offshore-based investors, right? And you need to also ensure for the entity, for the investment, that the main business that you are pitching are completely accounted for in this target company, meaning that you are not using different and completely separated entity for some part of the business, and you don't host any other business that is not part of the business plan in this company as well. So you need a dedicated entity for the investment. And the second one is the foreign business ownership, right? You need to make sure that your business is open for foreign ownership. It is what we usually call as negative risk. Because, for example, like in Indonesia, there are certain type of business activities that is restricted for foreign ownership. So you need to make sure that that is open, or otherwise we need to start thinking about the structure that will enable the investment. And the last thing is probably license, because what we see is usually for startup that is, running the business in highly regulated industry like payment or financial technology, insurance. The application for license can take some time, right? So that will definitely affect the timeline for you to roll out your product or business. So you need to be also, aware of that as early as possible. But I think rest assured, this is of course some things that you can also discuss with your VC partners if you decide to invest.
Okay, great. So I'm just curious on like, because what I hear from Florence and Denise, like it's more on like investor heavy, right? Like we put like a drag along, and then we put the that lever, good lever, and then lock in for the investor. Just want to check like from Neil, maybe you have the experience like from the company side, how usually they respond in terms of all of these requests, or probably they can see, oh, this is quite okay because they also invest the money to us.
Yeah. I think it's important to understand, and that's why it comes back to my early question is to when you will need an investor. Some people who has enough, savings, what we call as bootstrapping, able to, sustain enough until they are comfortable with valuations in a way that even there's a new investor, it will not like dilute them more than 50%. It can be lesser than that because there's a valuation involved. I think there's one question from Aldi, I think this is the VC guys may able to answer that, what's the valuation methodology and so on. But the thing that important is that whatever then the value of your company is, there might be time where, for example, like you get like East Ventures or Alpha invest, you talk with them in the year one and say, I value company now 2 million. And then you say, I still can go on for another 1 year. And I think by the time it's $5 million company. So I get less dilutions and I get more control of the company because the investor have less percentage. So that is also a strategy because to be honest, this is something that you need to make sure of from business side, how sure you are that your company will be scaling and you will get higher valuations. Because if you do investor will always think like this, they put a lot of stakes in you, they give you the valuations, and of course they want protections. What is kind of Florence give to us is some sort of protections that is kind of standard in the market. So, all the terms that you can get, you can have like guidance from the US Venture Capital Associations, the Singapore also have it. There's a lot of materials, albeit sometimes it's quite legalist, but if you kind of learn and read it, you might understand what it's actually about. And you can ask lawyers and me as well on that. But the thing is that whatever leverage that you have by that time, make sure you're ready. Because if you're not ready, then there's always been, it also ties to a question from Dimas to say, how involved is the investor of the investment company? It depends again on, do they give you a big valuations to make sure that they have returns? Or this is something that, you get like people say as angel investors, those who want to invest in you, but they don't want to spend too much time in it. I put you 100K or 500 maximum, like 200K, and then you run the company and feel free to ask me if you need anything, but I will follow whatever terms that you offer to me. So leveraging that depends again on the business side. And if you ask me how you should respond, again, I always ask my client to say, what's your leverage? What's kind of your in the States? And how important is to have that investors? And again, some people try to do it by way of have to investors, please compare the terms. In the end, I say, it's not the terms. The terms might be similar because, there's also some standard in the market on the very early stage terms or later stage terms. But the things, which investor you are more comfortable with and you feel that can be your business partners. Because in the end, with all the legal stuff, I don't quote me for that, but any terms is negotiable, but the trust is non-negotiable. You're not able to negotiate trust. You're able to negotiate the terms. So what I learned from my as like GCS Gojek and Ruang Guru and looking at the company over the years, if you have the trust, you deliver your performance. There might be terms that you don't like in the beginning, and then you say, yeah, okay, I will take that. But in the end, you say, now you trust me. Now you can, I'm doing a good steward of your money. I have like, develop or grow your money. It gives you multiples. Give me more trust, and in a way, give me more flexibility to run my business. And they will give, okay, now if you need to spend for 100K, you need my approval now because you are good. Then I give you more trust, and then you can spend up to 1 million without my approval. Or I can give you business plan to spend this and that. So all this is kind of interested to the trust. So my point is that it's important for you to understand what it is and get good advice, understand what's the implications. It may be say I don't like it, but prove it that you are worthy, that you are the Midas, you're able to grow the company, you're able to make more impact. And by that time, the investor will give you more trust and say, okay, I'll give it to you because I have trusted you over the years. I think that's kind of the principle.
Okay, that's also in line with what Denise say, right? Like they invest in the founders, and also in Florence say also like we trust the founders. We want them to manage the company. Also, maybe
yeah,
Denise.
One of the things that people are mistaken, and this is also with founders, is that this is not, and also lawyers, I think the lawyers friend here, is that sometimes lawyers think this is a joint venture between two big companies. Founders are as equal as investors. There are positions of unequal, unfortunately, especially in the early stage. That's why it's important to build that trust. In the end, as you get trusted, as you're able to deliver multiple, that power comes to you to say that I want this and that, but also comes a greater responsibility. With great power comes greater responsibility. And I've been through that kind of round to say we need to ask that, and it's hard-earned trust. But in the end, if you flop that, if for some reason you do something unethical or you do something that is tripping, you should ask for approval, but you don't do it, and so on. It will trip you back. So in a way, if you have it's like relationship. If you kind of have that trust, you will get that trust, and you will have to fight for that trust. But if you don't, then don't expect that you're able to negotiate as if you are a strong equal partner, because that will depend also on the economics.
Okay. On touch of the involvement of the investor, maybe Denise or Florence, do you want to add something on what will be the involvement of the investor to the early stage company?
Yeah, I think for early stage, Florence might be able to add some more as well. But I think from early stage, we see ourselves as a founder's thinking partner. It's not necessarily that we, be in the board to actually, control the operation and business of the company, because we invest because we believe in the business idea, right, of the founders. So it's more a thinking partner, check and balance partner. So I might be a little bit disagree with what Neil mentioned, come to VC only when you have proven your idea, because there's a benefit of coming to VC early, because VC sometimes have a big network of potential collaboration that might actually help you to run your business and find your business partners better, right? And usually the partners are usually have been, well versed in the industry, so might be able to give some guidance and to make sure that you don't run off the track as well. So that, there are some benefits as well to come to VCs early, but it's not the intention to actually, control the running of the business, because we as investors believe in the founders.
Okay.
To spice it, I don't say come early in a way. Don't take too much money from the VC early. You should come early because this is where I kind of see, and I think I kind of have, this is neutral, right? As EV, Alpha, I think because in Indonesia, but for example, Sequoia has this program, or there's a boot camp or whatever. startup programs where you get like grants and funding, and then where you get like VC mentors doing that. So commonly discuss, even I know some founders offered personal investment to some of the VC principal, or maybe some just to get like, do you want to put a little bit of seed, and it's also really kind of formalized, right? Don't put your full money. I want to prove it. I want to give you better valuations, and I want to be too much diluted. But put a little bit, and you see how I prove myself. So in a way, that what I meant is stop and come early, but don't take too much money too early. So that's the thing.
Okay, Florence, do you want to add something on this issue?
Yeah, so I think what Neil is saying is because like for startup, you will have more fundraising afterwards. So when you take so that's also the thing, for the cap table itself. So the founders should also calculate, yeah, as Dennis mentioned, that there should be ESOP, and also because sometimes at later stage, if sometimes new investor also wants to raise the ESOP percentage, and it usually will come from the founders percentage rather than the investor. So, but so mentioning about how we deal with with the portfolio companies, how many control that we are doing. So actually, as a VC, we are not really the expert of the portfolio itself. So but we know how to run a startup, but not like the business itself, because of course the founders will know better, right? So yeah, it's as what Dennis mentioned, that we can give some sort of guidance as well as assistance, because usually sometimes founders can come to just the founders. They even sometimes do not build a team, and the VC can help, for example, recruiting, and also giving idea how is the strategic plan to how to grow the company, about the marketing plan as well, and how you do the branding and etc. Because the idea with the early stage VC is we usually quite grasping the holding the founder's hand, and really assisting how they grow, because mostly it's still a small team, and we can and of course for a startup it cannot be just 2 or 3 person business, right? And yeah, and the very important thing is that for the founders to hire the right person to help them grow the company, and usually VC can help the founders to do that.
Okay. On the thing that Denise said that about restructuring the company and then putting or choosing the right entity, right? I want to have some question from here, like, what is the pros and cons having the holding company in Singapore and Indonesia? Denise, perhaps you can give some knowledge on that. Yeah.
Okay, sure. Actually, Mas Abdillah know the answer. Yeah. So actually, from investors' point of view, if we are a offshore-based entity, it might be tax and finance reason why it's more efficient to invest in Singapore holding company. But if you see it from legal perspective, right? As a Indonesian legal practitioner, we know that first, there's no such thing as Indonesian holding company in Indonesia. Right? We see that in the investment law, we see that in KBLI, there's no such thing as, having a license as a Indonesian holding company. You need to still have some sort of business activities even in your holding company, right? So there's a bit complication about that from legal mechanics point of view. And then I think there's also what will always be the concern from offshore investors is that the effectiveness of you holding a shares as a shareholders will only be effective after you inject the money, and then the company registered that to the MOLHR. So actually, there's not the common things for jurisdiction outside of Indonesia. So there might be some risk that the offshore investors see about that. And then I think the third one is also related to the capital market law and regulations, right? When you offer your shares to certain amount of people, you might trigger the IPO sort of stuff, which is, I think, not the intention of fundraising at the early stage or probably until, Series D or Series E. So that's my point of view, but probably Neil or Florence can add a bit more.
Okay, so I think Denise has touched some of the reasons, and also the other thing is, like as I mentioned previously, like we have the sort of like the lock-in requirement for the funders, and also like, so the idea is that like for the shares of the funders is still subject to repurchase by the company in the event they are bad liver or good liver. So the thing is like it would be a little bit difficult to enforce it in Indonesia, because once the shares is issued under the shareholders name, we cannot like force them to resell to the company. And also the thing is like for example, like I mentioned, like for the preemptive, like when they issue new shares, so the Indonesian law mentioned that it must be offered to all of the shareholders. But the thing is like with startups, sometimes like we have different arrangements. So sometimes we just like for the first round we only offer to major investor, and the second one to like, yeah, so and then like the remaining can be offered to the other shareholders. So that sort of thing that is like a little bit difficult to be enforced in Indonesia, but Singapore has more advanced company law, and it's a little bit like more free for the shareholders to regulate by themselves under the shareholders agreement and the constitution of the company. So I think that's why like many investors, especially foreign VC, they will require for Singapore or other foreign holding companies rather than Indonesia.
Just to add a little bit on that, Han. Of course, as Indonesian lawyers, I kind of keen to have that company law is kind of, from the process side, I think it's now as efficient. You kind of change of shareholding and so on with OSS regime is much more efficient. There are still some glitches in terms of how resolution would work, because it still have to be signed by everybody and so on. But one thing that I want to highlight, one of the cons, it's kind of, whether you see it as a cons, but for startup, it might be a con, is in Singapore, there's a big deal of transparency in a way that your filing will be public filing. So if you file financial statements, if you file, Indonesia is still there, but it's still only limited to like directorship, commissioner, directors, shareholders. But in Singapore, it's kind of more than that. It also entails some sort of a financial statement, albeit the format is not exactly IFRS or whatever, but you get recent articles, and the things that now there's a lot of sophisticated journalists, Tech in Asia, Deals with Asia, Bloomberg, that can easily, after you get filed, and then they can easily do kind of make analysis to you. And then you just have to anticipate when you kind of do that. There are people who can you kind of look like a public company, because that analyst can look at your numbers, and albeit is kind of maybe last year number, but it will have an impact, because you might be still in the early stage. So that's something you just have to keep in mind.
Okay, so I want to touch a bit on the question that Victor raised here. This is about the founders and employee remuneration. As far as I know, unlike some other jurisdiction, our company law does not really provide flexibility in structuring share capital as a way to compensate founder or employee. Whereas some creative way that you see or you predict will be a trend in granting ESOP or MSOP. I think Florence, maybe you wanna answer this question.
Sorry,
This is about the founders or employee remuneration and how we, we can, think about giving that in terms of Indonesian law.
Okay, so actually, usually almost all of our companies give the ESOP in the Singapore holding company. So the idea is, I think some of the employees as well as founders who misunderstood is that like the ESOP is usually still in the cap table. There is no shares being issued, because usually for startup, ESOP can only be exercised when they reach IPO. So what they are so actually what the employees is holding is the option, not not this not the shares itself, because most of the ESOP plan that I've seen from our portfolio companies and others as well, it's usually they can only be exercised, so they become the they become the actual shares when the company do IPO. So yeah, so I'm not sure what other creative way that is asking, but I hope that answers your question.
All right. So let's move to another topic, which is about the growing the startup, right? So I think I want to raise this question to Nathaniel first, as he already worked as the general counsel in 2 startups, right? So where will be the right time for the investor to really build the legal team in their startup? This will be relevant with the question that coming from Dede Fikri in our question and answer. Yeah.
Yeah, again, it's very important, but you can do it kind of in the stages. I remember when I started in Gojek 2016, there was only like 4 people, and then when I left in 2019, it's 50. So it's kind of combinations of acquisitions, new hires, international expansions, and so on by that time. But one of the kind of the philosophy, and this is also answering kind of the question, is to see where are you kind of in the, are you like, for example, one of the things that is important if you're a financial services company, and then compliance is a must. I think this is where Denise can get some give some idea and flavor. Then you need good legal team, because that team has to be at all times with the product team. If you have one that is not complying with the regulations or risk management or whatever kind of entails to that, then you are in jeopardy if there's an audit, because every year someone from the central bank or a JK will come to you and say you are wrong in this, you're not in accordance with this. So legal team is most important. That's why e-money company like Dana, GoPay, OVO, they usually have a sizable legal team. Where you should start. So if you kind of see, most of founders will not have a legal team before Series A. But by Series A, I would strongly suggest to have at least one junior legal, just to make sure that you have a good templates. You can have external law firms like Dede Fikri firms, my firms, to help build templates and so on. But you need to have someone to able to translate it to the business team. And a junior person will do with good mentoring, and then external law firms, or with like he has experience in law firms or other companies, they're able to do it. That kind of basic work. Make sure it complies with the intention with templates. Make sure have the licenses. Have good partners in Denise and Florence to ask question if they don't know. And that VC have sometimes a very, very good legal. I personally, in my Gojek years, for example, benefited from Chris Flossie, a GC of North Star, as my mentor. So that is very important in that kind of early stage. But then as you go into Series B, Series C, where you have more people in the cap table, you have divergence of interest, more regulatory challenges in a way that, from regulators, competitors, we heard about, IPO and because of regulatory challenges, it's get delayed. You get like that kind of challenges. And of course, if you get like US-based PE or strategic anti-bribery FCPA issues, we now have what we call the draft law on data privacy. You get all this coming in, then you might need a sizable team and the more senior people, like at least 5 to 10 years experience to be head of legal. That's where because it not just entails with the compliance of a certain license. It's not just entails of working the draft, but also make sure the whole kind of ecosystem or is in compliance with the shares agreement. Because sometimes what happens, you get like all provisions there, but because sometimes with founders or business actors, they sign it, but they don't know the details, and you need someone from legal who understand inside out and able to make it like in kind of detail. I think you remember our experience, Han, when we have a fundraising in Ruang Guru. Oh, we did that to have that policies and that, and then we have to start making that policies. We have to socialize that policies, and then we have to really make sure that they're being adapted, right? So it's not just another paper stacks in one of the director's decks. No, It has to be a live policy. So all these things needs a sizable legal team. It doesn't need to be like, 20 or so, but a team of 5 is the minimum, and we're all able to do whatever they need to do. So in a way that why is important, because as you get like a very good legal compliance, regulatory compliance, mitigations, risk management are all received for a next good fundraising. So if you're able to do it and you have a system working, I think building system is something I think I also want Dennis to kind of give some thoughts to that. But after you get that systems done and implemented, we did it at GoPayNis, in a way that you're able to build the stones for the next fundraise. And that is a more sustainable business, because you don't want, it's kind of, the business you build is a good product, people like it, is growing because of legal issues, then the business has to stop. So that's something that we don't want that to happen. I think Denise should be the next, because she is growing a lot and doing a lot of system work in terms of that in GoPay.
Yeah, thanks, Bang Neil. I think I concur with what Bang Neil said, right? We see that almost for Series A and above, startups started to have, 1 or 2 legal managers to help them with the legal works. But, startup with Series C, Series D above fundings, they will start to establish a proper in-house legal teams for a lot of reasons that Neil already mentioned, right? When you started to receive funds, for example, from corporate investors or US-based investors, for example, they will, ensure you to have a proper compliance in place. For example, like they will ask whether you have anti-money laundering or anti-bribery SOP in place, and then the ticket for funding is bigger in size, so that the risk is higher, and then your business is also expanding. You start to negotiate, a complex business collaboration agreement with sophisticated counterparts, and then you started to have a reputation, right? And you wouldn't want to risk it, which might affect your next fundraising due to non-compliance and a lot more reasons. This is extremely important for a company in a highly regulated areas like fintech or payment, because non-compliance will risk your license. So that's significant of having a proper in-house team as well, as early as possible that you can. And to answer Mas Didi questions about, how to have an effective legal team, is that see them as your business partner. The problem that we see in a lot of funders and startup is, they kind of like box legal, ex legal, right? And they come to legal when, there's a litigation case and there's a legal case and there's already an issue coming up as part of their business. But if you involve them early, which I think is what I enjoy the most during my time with Gojek as well, they have a better context, right? You include them in your product meeting, in your business meeting, and they started to get your vision, and then they start to understand where the business is going, and they will be able to give you a more, contextual and reasonable advice. Sometimes people see legal as being too strict, as being a blocker, because sometimes they don't get the context, right? So involve them early, give them a proper context, and the better will be the result, right? So I think that's how I see it, to have an effective legal team, see them as your business partner. And from lawyers' perspective as well, when you join a tech startup, it will be hard to give a legal advice just from textbook or your experience from legal perspective. You will need to understand the business context, because that will definitely affect how you see things. That will help you understand where the company is going, and you'll be able to give a better advice as well, and be their partners, not the blocker.
Just to add to Dennis, one of the things that I learned over the years of we lawyers, I think we have some lawyers here, is that we tend to think like a judge, right? It's right or wrong, and and sometimes the advice that we give is like that, is right or wrong, you're wrong, you cannot do it. No, yes, no, that is something that is difficult. You can imagine like a founders doing a visions, the product team, the tech team has built the building blocks. Sometimes we are not involved, only involved in the beginning, in the end, and say, no, you cannot do it. And there's something that is kind of hurtful and something that is not meet their logic. So the way that, I think this is something that Denise and I kind of struggled in our early days is, but we kind of try to think as a product people and product person to say, actually this is can if you do it this way, and apparently it's a bit of tweak for them rather than a big obstacle. So understanding the product design thinking, that is also important, because without that, you have to speak in the same language. And because we are supporting, we are a supporter, not a blocker, we are a partner, we have to speak their language. And this is something that is very important, rather than being a judge to say yes or no. It's really immerse what you're doing, and really goes into detail of analysis to say, oh, the problem is this actually. Can we able to think creatively on this? So the regulation is this, you need to do it this way. Or sometimes there are circumstances that we have to take a regulatory kind of exposure to say, because the law is fake, and somehow, yes, let's do it, is not exactly by the book in line, but this is our defense, this is how we do it. This is, for example, like payment, this is how we mitigate issues on KYC and ML, anti-money laundering, because that will be the main concern. So that kind of thinking is very important, because sometimes people don't say the same language, and that is the beginning of a disaster.
Okay, so also I have one question here, like in the later stage, which is talking about Series E, Series F, how do you manage each investor's need to be reflected in the shareholders agreement? Maybe I can hear the answer from Denise and Nathaniel, and then maybe from Florence. Can you add more on, like from the seed investor, what will be like the protection or things that you have to be aware of when the company is going into the later stage?
I think I will let Neil answer this, because he has the experience to renegotiate the whole shareholders agreement at later stage.
Again, it's one of the issue that we have is that, and this is a real story, is that, Series A investor put their terms, Series B investor put their terms, Series C, and then we are end up in a Series A when all the interests are aligned and just topping, and then we just basically have to comply with a lot of things, lot of interest, and a lot of tangled, comply with this, because sometimes we spoke, because one investor, oh, I want business corporations, the other, oh, I want board seat, this kind of stuff. And it's quite, the thing is, the company is becoming difficult to govern, and, board meeting feels like a shareholders meeting with a board meeting decision making, So like, for example, it should be just a decision of whether we acquire a company, but then we have to manage and talk with like 5, 10 shareholders. And it say, oh, I don't like it, it's my competitor. Oh, I don't like it because I have a portfolio company that is competing with that. So, all these kind of things comes into play. They don't say it, of course, but you kind of feel that there is concern similar to that. So I think what's important is just to remind what is at stake. So this is where I see the founders and the management kind of what at stake, why this is important, and kind of sell it and see, we need to do this because, for example, certain action, because there's no way to make the company governable, and without the company being able to be governed, then we have a company that's chaotic. It's like a parliament rather than a company. Parliament. So in some way, it's really talking with the, usually I don't say there's a playbook, but really talking with the initial state to say, hey, you already very diluted. Are you willing to give your board seat, but you are able to get an observer seat, for example? Sometimes it's difficult because they feel that I've been berjasa, I have a lot of deeds to the company, and I've been involved, and you call me for anything. Why now you want me to step down out the board? But sometimes, I think savvy investors already knows this, and they're basically fine with it as long as they are comfortable with the multiple and say, you still hear me, right? You still hear my voice, and you still kind of take my advice, right? And get kind of guarantees, kind of give comfort. And the thing is kind of balancing as well. You don't just, one of the things, the wrong take is to get that new investor and make it as a blame game. Oh, because of his asking, and somehow the company kind of end up, okay, actually the later stage is the one who's asking. It's not me as the founders. And then you should, and then somehow creating a sense in the board that is not healthy, because in the first day, oh, this is the person, this is the later stage, they're taking all my rights as an early stage investor. So in a way, that kind of decent and frank discussions and be truthful and reminds everybody, whatever we do is not because of this person, that person, is for the best interest of the company, and kind of prove it. So I kind of look at the process where, in Gojek Series E to F, we have incremental to say we kind of adjust it in some way or another, but kind of prove it that, and then people enjoy, oh, actually it's better, actually my worst case scenario is doesn't happen. Actually, it's facilitated a better discussions. And one of the other things that, it's also important is sometimes you have, especially in the bigger companies and groups, sometimes you have a change of personnel, those who are very influential, they kind of move ranks, they don't do the portfolio anymore, you get new people and so on. So remind everybody that it's not that I don't trust Denise or Florence, but maybe next year Denise and Florence will be assigned to other things and I get new people, and we need to get a good governance to make sure whatever the people is, whatever we do in the company was still the same. So that is something that I think is quite powerful to remind people it's not personal. Because sometimes what happens with this renegotiation call, is sometimes becoming very personal to say, you don't trust me. Again, that trust issue. But if we remind everybody and make sure the process is fair, make sure it's not one-sided, whatever the later stage or the early stage, make sure it's fair to everybody. It's a process. There's a lot of talking need to be done, but I think we have made a progress where it's more linear, and it's like exercise, right? You start exercising, you maybe like me, a bit overweight and so on, you start exercising and you feel better and you say, okay, now it's better, so I can start exercise more. So that kind of feeling, I think that we need to happen.
Yeah, I think just to add on that, Bang Neil, I think that it's important to have lead investors in each seat of shareholders as well. So you only negotiate with one instead of, the whole set of shareholders in a series.
Okay.
Yeah. I think we have a time limit. Han, it's already 8, but I don't know whether we want to take at least 1-2 questions and wrap up in 10-15 minutes.
Yeah. I can have one question more, but just ask my awesome panelists to just make a short answer for this question. There are like 2 questions in this, like a couple of questions. How do you legally avoid share dilution after scaling up? Is there any investment cap that you can impose, or will this just be a negotiation item between the founder and the investors? And the second one, for the proportion for the founder share and ESOP from your experience during growth stage. Okay.
Go ahead, the VC people. I think that you will answer better than me on this.
So I think it's difficult to avoid any share dilution. That's why, like what Nia also said at the very beginning, is that like usually the founder should start with a quite big chunk of the share ownership, right? So, and especially like if you read the news today, like Williams shares in Tokopedia is only 5% now. So like what is reasonable and not, like, yeah. So I think it's not something that would be avoidable. I don't think so. But yeah, that's why like I think it's important for the founders to strategize from the very beginning. And also so the thing is it also depends on the performance and valuation of the company. Like if the company perform well with a good, so they can get pre-money, a higher pre-money valuation at the later stage, so it will not get diluted too much. But the thing is for ESOP, I don't think so. I think there are, because certain investor has different views. Like I've experienced like meeting new investor, and they think like what they consider as reasonable as a percentage is actually different. So sometimes, as I mentioned, like they can ask the founders to give some of their shares to for ESOP. And the thing is like for us early investor, we usually do not, if later investor want to increase the ESOP percentage, we do not want to be diluted. So usually we ask the founders. But again, everything is it's usually negotiable and usually depends on the company's performance and valuation on that.
Nathaniel or Dennis, do you want to add something on this issue?
No, I think I cannot answer it better myself on that. Yeah.
Yeah,
Okay.
I think I agree with Florence that it's negotiated. But I think just on point one, just to add a bit on that, if you see it from founder's perspective, getting diluted doesn't necessarily means that you are losing your control, right? Because from the company perspective, the directors have the control to actually run the business and run the operational of the company, right? We also see that in a lot of structuring for startup that founders getting diluted, but they still maintain the management and the board seat to decide and run the company. So just a little bit add on that.
Okay. So the last two questions with a bit of personal. So maybe you can also ask directly to Nathaniel and Denise and Florence for this kind of question.
I think just to on that thing, one of the things that all the PE and VCs have, there's kind of strengths. I don't say weakness because all of them goes from strength to strength. I think one of the things is, for us, what is the best is make sure what's kind of your need. I think there's always been, in the market to say that Indonesian VCs are generally well connected in each other and they're able to, they know people. VCs in India, Sequoia, for example, they are very deep in tech. There are also VCs in Singapore, Open Space Ventures, and other kind of VCs that are, have quite a good of, a mix of what I say, mix of expertise that can support you. But the thing is that it's kind of finding who are you, it's not like one answers fits all. Is really in a way that try to get, it's like getting in a good schools where kind of the schools you like and which professor you think able to give you knowledge and support and mentoring needed. I think it's similar also with VCs. You meet with them, you see, you have chemistry. And the thing is that are they genuinely interested in your business? Are they have resources, not just the money, right? It's just resources to support you and connections. That is something that's quite personal in my view. And I've seen the success is more into that personal kind of connections, because sometimes you get like, even like until now, you get like VCs that is already got their multiples already developed, but they still look at it as their own company and really want that to be successful. So that's kind of feeling is very hard to kind of, there's some people who say already get multiple, I'm done. But some people are really trying hard as if your team, that is even for a PE, really be your team and really want to be successful, even like cheaper than a lawyers or consultant or business consultant you need to pay, but this is really pretty much your team. So that is something that a camarade that is very expensive to buy. So that's why you choose it, right?
So since Bang Neil give a bit of hint, about PE and VC, maybe Denise and Florence, do you wanna like give your opinion? Not the exact name, but more on like the nuance of the next unicorn.
Yeah, I don't
Maybe
think
you
I can
your
mention the
VC
name.
Lah. What is your good? What your advantage of your VC jualan dikit boleh?
Because I don't think I can mention which the name of the next unicorn, because of course we want all of our portfolios to be the unicorn, but I think we can see the trend, especially after this COVID-19 period, right? What will be the big demand in the market? We see that e-commerce is trending. We see that social selling is trending. We see healthcare. We see fintech. Yeah, those sort of startup, are having a high demand, especially during this COVID period. And from the payment side, we also see payment gateway, more players competing at those sector.
Okay. Florence, do you want to add something?
Of course, we cannot mention, yeah, as Dennis said, of course, we want every of our company become unicorn. So probably you can, before going to unicorn, the company usually go to the stage what we call centaur, which is like with lesser. So probably you can guess from one of them, or yeah, or we don't know, some probably there will be new unicorns. So like suddenly, so we don't know, like especially like with this, as Denise mentioned, like with this COVID time, like even SoftBank said, like it's no more like unicorn, but the company who can like survive during the during COVID period is the one who will grow stronger after this. So yeah, let's see. Like it's, yeah, let's see, and probably but we are very optimistic that like for Indonesia, we will have many and more unicorns in the next few years ahead.
All right. Okay. So thank you for Denise, Nathaniel, and Florence. I learned a lot immensely on this session, and I hope that all these attendants here also got new learnings here and much value as what I got. So thank you for the NYU also for hold this event. So yeah, thank you all.
Thank you. Thank you for having me.
Bye.
Thank you, everyone.
Thank you.